Mamma mia.
Tell your Italian grandma to break out the pasta and sauce because this market is red hot. And no, I don't mean that in a good way. I mean it more in like a bloodbath kind of a way because stocks are crashing. And if you want to be super technical about it, as of today's close, from the previous all-time high to right now, we are down in excess of 10%, which is officially a correction territory. And yes, that is bad. But if you want to see something even worse, check out what's going on in the small cap sector because at one point it was down in excess of 20%. Absolutely brutal. So what are we going to chit chat about in this video? Well, I want to give you all the major news that you might have missed throughout the day, but most importantly, I want to talk about how in the short term, I'm expecting a little bit of a relief bounce that might end up turning into a dead cat because I think next week or the week after, we're actually going to see another fresh low. And then from there, really in the month of April, I think we are going to skyrocket higher. So as you can tell, we have a lot to talk about. If you enjoy these type of market breakdowns, don't forget to like, don't forget to subscribe. And with that being said, let's rock. By the time the world's largest casino officially closed on the day, here was the headline. S&P 500 closes in correction territory Thursday as stocks tumble again on the Trump tariff threats. If you want to look at the heat map of the S&P 500, it is red mad, especially the tech sector, which was so green and dominant yesterday, just like that, flipping and now horrifically red. The overall market, the SPY dropped 1.3%, the Nasdaq dropped 1.8%, and then some of our favorites, some of these mega cap like the Mag 7, which were super green yesterday, now turning super red today. It's just brutal. And if you want to know how we got here, man, oh man, it felt like we had 5 days packed into one based on the amount of news. So when we woke up early this morning, Trump threatens retaliatory 200% tariff on European wine after EU proposes American whiskey tax. So the EU tried to clack back, and then right away Trump is like, nah, your wine, your champagne, your spirit, we're going to jack those up. And then right after that, we got an inflation report. And this might sound crazy, but inflation came in lower than expected 2 days in a row. Low inflation, low inflation. You think it would be good, but the fact that the market went off tells you how brutal things truly are. Anyway, February PPI, the producer price index, inflation falls to 3.2%, which was below the expectations of 3.3. The core PPI, taking out food and energy, came to 3.4 when the expectation was 3.6. So right now, yes, both CPI and PPI are below expectation, which is a good thing when you're coming from a high inflationary environment. But obviously the craziness with tariffs and the uncertainty really shows how brutal things are. Imagine where the market would be right now if inflation actually came in higher. From there, why this week's positive inflation reports won't look as good to the Fed. On the surface, February's inflation data brought some encouraging news, but underneath there were signs likely to keep the Fed on hold when it comes to interest rates. Remember, the golden question right now is when are we going to get the Fed rate cut? And due to both of these reports, they're actually kicking the can down the road a little bit. While the consumer and producer price indexes were both lower than market expectations, that won't necessarily be reflected in the main PCE price index measure the Fed uses to gauge inflation. So the Fed has said this multiple times, and there's many measures of inflation, but according to the Fed, and really Jerome Powell himself has said this multiple times, they weigh the PCE report the most, and the last reading we got from that was actually a bit hot. In short, progress on inflation has started off 2025 on the wrong foot. Not exactly what you would want to be hearing in this moment in time, but like I said, lots of other news today. Crazy, in fact. Putin wants direct White House talks before Ukraine ceasefire, but says he's open to deal in principle. Now, if you want the exact nuanced details of what this was and wasn't, I implore you to look it up. We could put some links below, but what you really need to know is that seemingly good? Question mark? Like, I know tensions are there, but every day it seems like both sides, Ukraine and Russia, are kind of being dragged to the table to come to some sort of ceasefire agreement. So when this was first announced, the market did have a bit of a pop, so that was good, kind of undoing some of the tariff news. But then we got other wild ones. Greenland PM blasts Trump talk of U.S. annexation. Enough is enough. Yes, you are hearing this right. At one point today, Trump was once again on the horse of, Greenland might as well become part of the US. Obviously, the people of Greenland not so stoked that he keeps saying that. And then that led us to even more tariff talk somehow. I get it. I know that this sounds crazy and all over the place, but that's exactly what today was. I'm not going to bend down. Trump doubles down on tariff plans as stocks sink. Right now, there's a lot of chit chat of not only what's going on with alcohol, but more recently, the steel and the aluminum, and we jacked it up, brought it down, jacked it up, brought it down. But remember, we still have April 2nd coming up on the calendar, and that's when the retaliatory tariffs are supposed to take effect. I'm not going to bend at all. The comments came as major stock indices continue to tumble, with the S&P 500 falling 10% from its recent highs and entering the official correction territory. Now, what I do want to show you amongst all this craziness is the option market agrees. It was also crazy. Right here, we have spot gamma. The white line is the price movement of the S&P 500, and then overlaid on it is the options movement. We have the 0DT and we have the all expiration. You can tell completely disconnected today. We just kept going down and down and down, and granted there were some decent bumps, but we just kept selling. The options market ever since 956 was actually decently strong. And I also want to point out how at the end of the day, longer duration puts were being closed out. This is interesting because if we have long duration puts closed out, and on top of that, if we were in the situation that volatility starts to collapse, that's the perfect ingredient setup for the Vanna rally recipe. So I just want to call that out, and it actually has part of the reason of why I think we could get a little short-term bounce, which I do believe is going to be turning into a dead cat bounce. But before we get to that, I do want to call out how we are in that correction territory, down 10.2% as of market close today, and at the most extreme we were down 10.46. So yeah, it's brutal. The market's getting beat up. That looks really bad. I kindly want to remind you, we've been in sell-offs like this before, and if anything, we know major dips are to be bought. The question is when is this one going to actually dip? So I do want to say, in the short term, not only are we at this key level of 5,500, which is huge in the open interest if you're looking at the option chain, but because I see these options getting sold, okay, there's not so much bearish aggression. I also want to call out the fact that we have some positive gamma now underneath us. Before today, this didn't really exist. It was all negative gamma everywhere, which is interesting because not only are we at key technical and psychological and option support, but we're seeing this point where the risk reward is actually getting more favorable, once again, in the short term to play a little bit of a pop to the upside, potentially all the way up to 5,700. So this is just a guess, and albeit a little bit of an informed guess. I'm looking for the next week or two to play out in this situation. I'm looking for a bit of a bounce. I'm not going to call for anything crazy. And then I'm looking for it to kind of weaken and then just completely plummet and either tie this low or make a fresh low. And then from there, when we can finally get past not only the March OPEX Friday, March 21st, where all that negative gamma and all that crazy delta moves are going to be removed, but we also have the FOMC meeting. That's going to be removing some uncertainty. And then the week after that, we have the JP Morgan collar position that's going to be expiring. Once we can take all those option plays off the table, I think that's what we're going to really be seeing the opportunity to play it massively back to the upside, because once you remove all that gamma and delta, most likely people are going to not necessarily be chasing puts at this juncture. And then if vol starts to collapse, that is exactly what you need, which I was alluding to before, of that Vanna rally, except this one I don't think is going to be a baby one. I think this one could be a very big one. So I'm looking late March, early April to throw in a position to play that. Obviously, as we get closer, I'll keep you apprised of the situation. Now, very quickly, taking a step back, talking about why I think there's a little dead cat bounce in the near term, I do want to remind you that we do track the seasonality, and this isn't the end all be all, but coming into the final day of the week, Friday, March 14th, this day does historically favor the bulls. For quite a while, it was bearish and then flat, but over the past 7 years, it's definitely developed more of a bullish tune. So just seeing that we have all that positive gamma beneath us, we see some of those puts closing out, we see a bit of weakness in the VIX, and we also see some seasonal bullishness. It makes me think that the odds are starting to increase once again for a dead cat bounce that I think pops, fails, we see either a tide low or fresh low, and then things get truly exciting as we get closer to April. Another thing I want to share, just to maybe potentially calm some minds down, especially if you're an investor seeing your account get really rocked right now. These are the stats, facts, and figures related to the NASDAQ after a 10% pullback, which obviously that's exactly where we are. So looking at all the times that that's happened, what happens 2 weeks later, 1 month, 3 months, 6 months, and 12 months, what I find very interesting is 1 month later, 80% of the time, the market's in the green with an average return of 3.7%. And then for those of you who have a little bit of a longer table, 12 months later, 90% of the time, the market's in the green with an average return of 21%. So I know a lot of the times in these videos and in the show, we're doing a lot more short-term stuff. But for those of you who are maybe getting a little bit nervous of how the longer picture looks, the odds are very much still in the bulls' favor. So I just wanted to share that. And I wanted to share the most recent updates, not only in news, but what's happening with options, but really my personal price predictions of how, yes, things are extremely bad right now. I think there's a bit of a relief. Then I think things get worse. And then I think there's going to be potentially the trade of the year by riding this back to the upside. That's how I'm currently seeing things play out. Obviously, if you have any questions, comments, concerns, let me know in a comment below. Obviously, I appreciate your time. I appreciate all the good vibes. I'll catch you in the next one. Peace.